It's Brian Preston, the money guy.
And this is a trap that a lot of Americans fall into, debt.
Yep, absolutely.
So let's talk about how we navigate this. First of all, I want to give you kind of a state of where the market is with debt issues. Let's talk about what's going on with credit cards over the last few years.
Yeah, now what's really, really interesting is that overall credit card debt, when you look at the average credit card debt carried by credit card users, it decreased sharply at the beginning of the pandemic. In 2020, when the COVID downturn happened, it actually went back to 2017 levels. Now, you might be saying, okay, well, great. People made the volitional decision, hey, we're going to cut back our credit card debt. I don't think that's what happened.
No, they actually built up. It's almost like they were waiting to load the boomerang, or load the slingshot. While they were locked down, while they had the money coming in, it was building up in the coffers. But as soon as their local community kind of let them out of the house and let them back out, they were like, spin, 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 spin. And we've actually seen those numbers come right back up, just like a slingshot. And that's troubling, guys. Remember, I want you to be very healthy with understanding the privilege of credit card debt. Don't fall into that debt trap.
Now, here's the one good side. It has not quite gotten back up to pre-pandemic levels. Unfortunately, it looks like it is moving in that direction. So it's something you want to make sure that you stay mindful of. And the same can be said for student loan debt, because that's another type of debt that we see frequently that is becoming more and more of a headwind, specifically for young people who are trying to begin their wealth building journey.
Look, the magnifying glass is on higher education, and that's why as a result of I like to think we're part of that chorus of people trying to draw attention of don't turn something so positive into a negative for the younger generation. So you've seen schools and education sources they've moderated on how much the price increases have gone up in the last few years, but still, it's troubling, guys. I mean, if you look at, we have a great stat here that we had Daniel put together, and we want to explain this to you. They're showing that, look, over the last number of decades, we have the average cost of tuition, room, and board. I mean, we're over $20,000 a year, right? Over $22,000. Daniel brought it back in today's dollars, what it would have cost in 1971 in today's dollars. And you can see it was under $9,000 a year as early as this 1970s. So we've had this 2.5 to 3-fold increase in over the decades. And you have to ask yourself, why did this happen? What's actually causing this issue? Because this happened before we had this whole hyperinflation issue currently. And Daniel and I did it was pretty amazing. And I want to encourage you, if you haven't checked it out, go check out FYI by FTE on Substack, because Daniel's done some great writing and research on what causes these systemic changes in the way we receive stuff. And let me give you a stat to give you some perspective on this. In 1978, if you were just making minimum wage, which was $2.65 back then, you'd only need to work 808 hours per year. That's about 20 hours a week to pay for college.
So essentially a part-time job working about half-time, and you could put yourself through university. That does not, I worked when I was in school. Yeah. That doesn't sound insane. That doesn't sound crazy to me.
That sounds somewhat healthy. That's a fair deal. You go work a part-time job, you pay for college, you have time to study. It all works. Let's fast forward to 2020. Now the minimum wage is $7.25, $7.25. You would have to work 3,059 hours per year, or 59 hours a week just to pay for college.
So a part-time worker earning minimum wage could have put themselves all the way through university in the 1970s. And yet today, you would not just be able to work full-time, a 40-hour working week. You'd have to work full-time plus overtime, which doesn't leave time for actually going to class, doing homework, getting your stuff done, retaining the knowledge. It almost seems unattainable without either having parents that can help you pay for it, or sources to pay for it, or going out to take on student loans.
This is how you turn what is historically an incredible positive for society into a negative for our younger generation. And if you ask yourself, how did this happen? How did we get here? We actually did some pretty cutting-edge research on this, and we found that a lot of it happened in 1978 when the government passed, and this is why you have to be careful. The road to Hades is going to be paved with good intentions, is the Middle Income Student Assistance Act of 1978 was kind of the dividing line when the government started issuing more grants, more financial aid. Instead of that making college more affordable, it actually just gave the institutions the green light to start raising their prices. It's not like they said, hey, we're going to allow more people in at the same low costs. They said, no, we have the same number of people wanting in. We don't have to let them in. We'll just raise the prices to take advantage of this new supply-demand opportunity because the government's now got their money involved in it. Very disturbing trend, and I would encourage you to go check out the FYI by FTE Daniel on Substack so you can sign up for that newsletter and see all the great research and writings that we're doing on that.
Or you can just go to fyi.moneyguide.com if you want to see some of the stuff that Daniel is putting out there. Now, here's an interesting one as it relates to debt, because we've talked a little bit about student loan debt. We've talked a little bit about credit card debt. Mortgage debt has also been something that's been a bit alarming. It's been increasing sharply at a rapid pace given what's been going on in the housing market over specifically the past year, but really the last couple of years.
Yeah, so I mean, I think as we've gone through credit card, we've gone through the student loan debt, and now we're talking about mortgages and so forth. What does a financial mutant do about these things? We've already covered previously credit card debt, no-go land if you're actually carrying a balance. Be very responsible about that decision-making. Student loan debt, guys, this is something, like I said, it's a positive that I do not want you to turn into a negative. I want you to be very proactive. I have a senior in high school. I know what it goes into trying to make sure that you're applying for scholarships, qualifying for as much performance-based stuff. If you come from a lower income family or you have some skill sets or writing abilities or other things, apply for the needs-based as well as some of those other merit scholarships, because all of those things, your future self is going to thank you so much. But then it's also important, know your guardrails with student loans. I mean, guys, we give the guidance that I don't want you taking on more student loan debt than what you anticipate your first year's salary. So let's take somebody who you think you're going to come out of school making $45,000 a year. Don't allow your student loan debt to exceed that $45,000. What I don't want to see you do, if you know you're going to start a job that starts lower, like $35,000 to $40,000, don't go to some private school out of state that costs you and you run up $120,000 worth of student loan debt for that $35,000 to $40,000 a year job. You are starting from the whole slot of starting your life. You will be behind tremendously. Pay attention to those things.
I think when it comes to debt in general, you have to know your specific personality. Credit cards are a great example. If you can't pay it off monthly, don't use them. You don't have to have credit cards. There's nothing wrong with using cash or using debit cards or doing an envelope strategy. Whatever works for you, don't use them. If you're someone who's afraid that when you get onto the dealership showroom floor, you're going to be talked into the more expensive car, the higher trim package, and the answer is going to be, oh, well, you said you could afford $300 a month. Well, if you just stretch out your loan a little bit farther, we can keep your payment at $300. If you know you're susceptible to that, go into that entire process. Go into the entire negotiation knowing exactly what you're going to buy, how you're going to buy it, and what the terms are going to be. There is no reason anymore for someone to walk into a car dealership being uninformed about how they should leave that transaction from a financial perspective. Know yourself. If you cannot handle that, if you're afraid you're going to be sold, get someone to help you. Figure out a way to do everything without actually talking to a salesman so that you can keep yourself protected.
I wanted to close on the last. We talked about mortgage debt. And these are unique times. Housing is appreciating rapidly. For those of you who already own homes, congratulations. More than likely, you're the beneficiary of that inflationary pressure, and real estate is booming right now. But you're also the beneficiary of this super low interest rate environment, because remember, it's artificial, so it's not unlikely that your interest rate on your primary residence is less than 3%. From a historical standard, that is ultra low. And I just get so troubled by the fact when people are under 45 years of age and they're in that crucial compounding growth phase of their life from 20 to 45, and instead of investing in the Roth IRA, maxing out the 401ks, building that bridge account with after-tax investments, We see people who use that extra and they use the feel-good moment of getting out of debt as fast as possible to pay down that 2.5 to 2.75% mortgage rate when you should be letting that money work for you and build your army of dollar bills. Now look, get over age 45 and you know your compounding effect is not as strong. You've also built a tremendous foundation in the background from all those years and decades of saving and investing previously. I'm perfectly fine with you finishing the drill, paying off that debt early. Just understand, what does this market of high inflation, low interest rates mean for your financial life, and maximize that opportunity.
And if you're trying to figure out exactly what to do with your next dollar, we have a great course for you. You can go to learn.moneyguide.com and look at our financial order of operations course that will walk you through decisions like, should I prepay my mortgage or should I build up my emergency fund? Yeah. Should I pay off this debt or should I max out my retirement options? And we actually walk you through a step-by-step process of how you should approach that.